This is a debrief of the Drafting and Interpreting Financial Statements AAT Sample Assessment 1, Task 5, which deals with preparing a set of group accounts and consolidated financial statements. So on the screen you can see the data that the question has provided, which is available in the references area in the exam software. And we're looking at the statement of financial statements for Breeze and Elegant for 31st December 20X1. So you've got the statement of financial position for the two companies. The question also provides us with some additional information, and we'll need to make some adjustments to our answer for that additional information. The exam software also provides us with an answer template, so we need to be able to complete our answers within this. In your exam, you should also have scrap paper provided, and this is going to be essential for you working out the answer for this. And so on the right hand side of the screen, we've just got some blank area there, which we're going to use as our scrap paper for illustrating how to work out the answers. Because we will need to add together all the various numbers to work out the group accounts. And we'll use the answer template to help us to structure that. The exam software also provides you with some space for some workings as well. However, these workings templates are quite short and they may be quite difficult for you to be able to complete all of the workings that you need. So when you go into the exam, one of the things it would be good for you to do on your scrap paper is prepare extended workings to help you to do these questions a little bit more effectively. So that's what we've prepared for you just below here. So for our goodwill working, we'll need to include the consideration. So how much are we paying to buy the shares of the subsidiary? We'll also need to consider the non-controlling interest as well. And then from that, we'll need to deduct the fair value of the net assets. Now, what do those net assets include? So net assets will include all of our property, plant and equipment, our inventories, our receivables, our cash. But remember, it's net assets, so we'd also need to deduct our bank loans, our payables and our tax liability. And that can be quite time consuming in the exam. So a shortcut is just to focus on equity. Yeah, so our share capital and retained earnings are the same as our net assets. So for exam purposes only, but not in the real world, so in exam purposes only, we can represent the fair value of our net assets just by considering equity. That's an exam shortcut. So you notice that our goodwill working is a bit longer than the space they've given us in the workings. Now it's up to you. In the assessment you can use the goodwill working to help you, but if those 3 lines there are not enough for you to get your head around it, then you may want to do a more full working on the scrap paper, as we're going to do now in the video. And then similarly, we've got just 3 lines available for retained earnings working, which may not be enough space for you to do that retained earnings working effectively. So again, we've created a template here at the bottom right of your screen. And notice what we're going to do. We're going to consider the parent company and the subsidiary separately. So hopefully we can just get our head around it a bit more easily by looking at them separately rather than all in one block. And what we're going to do, we're going to consider what are the retained earnings now, what were the retained earnings on acquisition, because remember what we need to do, we need to include in the group retained earnings all of the parent company's retained earnings, but we should only include the parent company's share of the post-acquisition profits of the subsidiary. So we need to compare what is the difference between retained earnings now and retained earnings when we bought the company in the first place. And then that will give us what we should include in the group retained earnings. And then we also need to take into account that there may be some impairment of goodwill, so that's also part of our template. And then that will give us our total retained earnings for the group. So if you've not done so already, you may want to start trying to remember these workings, and they will help you to structure your answer and hopefully not get a bit lost. Because as you've seen in I'm sure many of the questions you've been practicing so far, that there's a whole load of information and it's easy to get lost in and get overwhelmed by all the data they provide. So the next bit then is that we want to earn as many marks as quickly as possible. So there is an order to which we should be dealing with the information they provide us. So they have given us that additional information, so we should leave that until the end. And they've given us the two sets of financial statements. So we'd recommend that the first thing you should do is on your scrap paper, set up all your workings. So what we'll need to do is set up our statement of financial position using all the headings that they've given us in the question. So it's going to be quite difficult for you to update all of this information in the exam software. So we need to replicate all of these headings that they've given us in the question software on the scrap paper. And then we'll also need to set up our workings as well. So having done that, what we can do now is start to transfer all the information they've given us in the question and put them into our answers. Remember, there is a highlighter tool in the exam software, so it's useful that once you've put the number into your answer, you can highlight it, and then when you get to the end of the question, you can look for any numbers that you've not highlighted yet, and that tells you still need to do something, that you've not completed the question yet. So in what we can see on the screen at the moment, we've got these two sets of financial statements for Breeze and Elegant. And remember that these are part of the financial statements already. A double entry has already happened for these numbers. So all of these numbers should appear in our answer once only. Whereas in the additional information, we still need to do a double entry for these. So all of the numbers that are here should appear in our answer twice. And that's going to help us to keep control of our progress. Okay, so let's start putting the numbers from the balance sheets into our answer. So we can see there in assets, we've got our non-current asset, the investment in Elegant. Now, before we start looking at these numbers, where to put them, remember, we're preparing a set of group accounts. We've got Breeze, the parent company. We've got Elegant, the subsidiary, and we are preparing the group accounts. And what we're interested in are any transactions between the group and any third parties. Whereas anything that's going on inside the group, that's internal, and we don't want to include those. So first of all then, we've got this investment in Elegant of 800. Well, that's inside the group, so that's not going to appear in our statement of financial position. But it will appear in our workings, and that's going to appear in our goodwill working. That's the consideration, how much we've paid to buy those shares. So let's put that 800 into our goodwill working. There we are. So we've paid 800 to buy the shares. So using the highlighter tool in the exam, we can highlight that. We've dealt with that number. We don't need to worry about it again. And then we have property, plant and equipment. We've got those two numbers. Now remember the definition of an asset. An asset is an economic resource that we control as a result of a past event. So we know that the parent company controls some assets, so they need to be included in the group assets. But also the subsidiary has some assets as well, but the parent company controls the subsidiary. So while Breeze doesn't actually control those assets directly, they do control them indirectly. So for the whole group, we control the property, plant and equipment of Breeze, and we indirectly control the property, plant and equipment of Elegant. So we just need to add them together for the group accounts. And so we can put both of those numbers into our answer. So what we're going to do, remember that we on our scrap paper, we're just be adding the numbers together. and so I want to keep an eye on what's going on here. So we need to think about Breeze, and we need to think about Elegant, and I need to add them together. So for property, plant, equipment, we have 3572 for Breeze, and we have 684 for Elegant. Okay, so we've put those two numbers into our answer, so we can highlight them now. Okay, we've got some totals as well, but I don't need to worry about that. So we also have some inventories, and the same applies for the inventories. These are assets that we control either directly or indirectly. So these two numbers can go into our answer on our scrap paper. So we have inventories for Breeze of 396, and we add on the inventories of Elegant of 202. So those two numbers are in our answer, so we can highlight them. Then we have receivables. Again, these are two more assets that we control, so we can include those numbers in our scrap paper as well. So we have receivables of Breeze of 294 and receivables of Elegant of 121. So those numbers are in our answer, we can highlight them. And then finally we have cash and cash equivalents of 150 and 33. So those two numbers can also go into our group accounts. We have cash for Breeze of 150 and for Elegant 33. Okay, moving on, we get to the equity area now. So for our share capital, so let's think about our shareholder sitting at the top of our group. And remember, we're preparing a set of group accounts for the owners, for the shareholders. So how many shares does that shareholder have? Well, that shareholder only has shares in Breeze, and they only have 4,000 shares. So the 4,000, that's the number we want to appear in our group accounts. The 600 is part of our internal investment, so we don't want those to appear in the group accounts. So for our share capital, we want to put our 4,000 relating to the parent company, and that's going to be our total that goes into the group accounts. Whereas the 600, where is that going to appear? Okay, we've got our 600 for our subsidiary. Well, that's part of the net assets of the subsidiary, isn't it? So that means that's going to be part of our goodwill calculation. When we buy the subsidiary, when we buy Elegant, we're buying control of their net assets. And remember, net assets is the equivalent of equity. So we're putting that 600 there. So we've put those two numbers into our answer. We can highlight them now. Next, we have retained earnings. Now, these are the retained earnings now, and they're going to appear in our retained earnings working. So remember, we've separated two different columns for Breeze and Elegant. So we have retained earnings now of 628 for Breeze, and for Elegant it's 150. So we've used those two numbers, and we can highlight them. We've got some totals which we don't have to worry about at the moment. And then we have our non-current liabilities. Well, this is going to be treated in the same way as the assets. And remember, a liability is a present obligation as a result of a past event. So we have these two sets of obligations. Breeze has obligations, Elegant has obligations, so the group has obligations for both of them. So we can put both of those numbers into our scrap paper for the bank loans. So Breeze has bank loans of 274 and Elegant 186. Yeah, so when we add them together, that will show the obligations for the whole group. Yeah, so we can highlight those two numbers. And then we've got trade payables, so we can do the same for that as well. So we've got our trade payables of 268 and 94. And while we're here, to save me scrolling up and down, we've also got a tax liability of 42 and 10. Okay, so there we are. We've gone through the statement of financial position and we've included all of the numbers somewhere in our answer, either in the statement of financial position working, or in the goodwill working, or in the retained earnings working. We've not included any of the subtotals, and we don't need to bother with that really, because those subtotals may change once we've done the consolidation adjustments. Okay, so in our workings there we can see all the numbers in green from the statement of financial position that they've given us. So we're going to change colours now. We're going to go to a purple colour to go through all the additional information. And here the numbers will need to appear twice because we're going to be doing some double entries. So first it says Breeze PLC acquired 60%. So 60% is more than 50%. So that's confirming that we have a subsidiary. We have control over the subsidiary, don't we? So 60%. So we need to put that number somewhere into our answer. So where is it going to appear? Well, we need to recognize that if we're taking control of 60%, that means our non-controlling interest will be 40%. Okay. Also in our retained earnings, we're going to work out a subtotal, aren't we? This total will be the post-acquisition profits, and we need to recognize that we are entitled to 60% of that. Okay, so that's the 60%. Right, let's read on. So I've used that number now. I've put 60% twice in my answer. So we acquired 60% of the issued share capital and voting rights of Elegant on the 1st of January 20x1. Okay, so that was some time ago, for 800,000. Oh, well, that 800,000 we've used in our answer already, haven't we? That had already appeared in the statement of financial position of Breeze. So we've already used that number. We don't need to use it again. So at that date, Elegant had issued share capital of 600,000. Okay, well, we've already used that number, haven't we? That's already in the statement of financial position. But it had retained earnings of 100,000. Okay, we've not used that yet. So that needs to appear in our answer. Remember, it needs to appear twice. Okay, so where is it going to appear? Well, that's part of the fair value of the net assets. So when we bought the company, retained earnings were 100. So that tells us that the net assets were worth 700 in total. Remember, that's what we're buying control of, isn't it? So it's appeared once, but it's also going to appear in our retained earnings calculation, because that tells us since we bought the company, the subsidiary has earned profits of 50, and we are entitled to our share of those post-acquisition profits. So I'm not going to work that number out yet, because there may be some further adjustments. So actually, let me get rid of that 50, because there may be some further things we need to do with it in a moment. Okay, but at the moment, it looks as if we've earned 50 profits since we bought the subsidiary. So you see that number 100 has appeared twice in our answer. I can highlight it. I don't need to worry about that. I've done the double entry for that. Now it further tells us the fair value of the non-current assets of Elegant on that date was 200,000 more than the carrying amount, and the revaluation has not been recorded in the books of Elegant. Okay, so that means we need to make an adjustment for that fair value. So it tells us that our property, plant and equipment is worth 200 more than the book value. So we need to increase our property, plant and equipment by that 200. There's our debit. But also that's part of our goodwill calculation, because we need to consider the fair value. What's our fair value adjustment of our net assets? Because remember, we're paying 800,000 to buy Elegant. And when we're paying 800,000, we're going to take into account that the real value of those assets is 200 more than what it says in the balance sheet, which means we're probably going to spend 200,000 more to buy the shares, aren't we? So if we're considering the fair value of the business when we pay the 800,000, we also need to consider the fair value of the business when we work out our goodwill. Yeah, so we need to be consistent. So there we see there's the credit, the 200 appearing in our goodwill calculation. So we've used the 200, we've done the debit and the credit, so we can highlight that. Next, during the year, Breeze sold some of his inventory to Elegant for 70,000. The goods had cost Breeze 54,000. Okay, so let's just consider how much profit we're making on this. So we've got our sales revenue of 70,000. We've got our cost of 54,000, and that means we've made a profit of 16,000. Now, what's the significance of this? Okay, so we had our little diagram. Let me draw the diagram again. So remember, we've got Breeze, we've got Elegant, and there's our group. So Breeze sold some goods to Elegant. So that means that there was some inventory, and that inventory was purchased by Breeze for 54, and then it was sold to Elegant for 70. So at the moment, Elegant has the inventory. Okay, and Elegant is showing that inventory at its cost of 70. But remember, according to IAS 2, inventory should be stated at the lower of cost and net realizable value. Well, the cost to Elegant is 70, but the cost to the group was 54. So that means we need to reduce the cost of the inventory down to the original cost to the group, which was 54. And therefore, that profit needs to be removed. However, it further tells us that 1/4 of these goods were still in inventory. So we only need to make an adjustment for the inventory that is still sitting in the accounts. So we need to multiply that by 1/4, and that gives us a profit adjustment of 4. And we need to reduce the value of inventory by 4. So it's at the lower of cost and net realizable value to the group. Okay, so we need to reduce inventory. So there we are in our scrap paper. We can reduce inventory by the 4. And that's a credit. And the debit will go to cost of sales. But we don't have cost of sales here. But if we're going to have an extra expense in our accounts, that means our retained earnings will also go down. So yeah, we need to make an adjustment for our unrealized profit. Now we've got 2 columns in our working here. Now this is important. We need to make the adjustment in the company that made the sale. And it told us that Breeze made the sale here. Now the significance of this is that if Elegant had made the sale, then we would only recognize 60% in our retained earnings. So it is important that you put this in the right column. Okay, so Breeze made the sale, so we make this profit adjustment in Breeze. Okay. Right, so we've done our double entry for that. So I can highlight, so yeah, all these numbers now, yeah, we've made the debit and the credit. So it's all telling us there were no intercompany balances outstanding at the year end in respect of this transaction in the trade receivables and payables. Okay. Now, if there were, it means that we would have some negative number here to reduce receivables and also some negative number here to reduce payables. And because this is a receivable and payable that's inside the group, and therefore we don't really care about it. We only want to know how much do external customers owe us and how much do we owe to external suppliers. As this is internal, we'd eliminate them. But in this case, it says there's nothing outstanding. The next note then, Breeze to decide non-controlling interest will be valued at their proportionate share of net assets. Okay, we need to deal with that in a moment. And the directors determined that goodwill was not impaired. Okay, so there's nothing for us to do there. So there we are, we've dealt with all of the numbers. So it's now time to start completing some of our workings. So let's start off with our goodwill calculation. So we can work out now that the total value of Elegant when we bought it, get the net assets, the fair value of the net assets, we've got a total of 900. And that needs to be deducted to work out our goodwill. But we need also to work out our non-controlling interest. And it told us that we worked that on the proportionate method. So that means that 40% of the 900 should be included as our non-controlling interest, and that is 360. So that means then that for Elegant, what's the total that everybody's contributed to own the business? We've paid 800, and the non-controlling interest have effectively paid 360. So collectively, we have contributed 1,160,000 towards the ownership of Elegant. Now, the value of the business is 900, and that means that goodwill is 260. It tells us that there is no impairment, but let's imagine that there was. Okay, so if there was an impairment, we would deduct some number from that 260. That would be the credit, and a debit would appear here in our retained earnings working. But in this case, there is no impairment. So that means we can put the 260 straight into our final answer now. So goodwill, 260. This is for the group accounts. Okay. Now the other thing then, we can do our retained earnings. So we've got some numbers here, but we can think about Elegant now. So yeah, we identified, didn't we, that Elegant has retained earnings now of 150. It had retained earnings of 100 when we bought the company, and that means Elegant has earned 50 of profit since it was part of the group. And we are entitled to 60% of that. So we are entitled to 30 of their profits because we own 60% of the company. So that means when we add up our total column, that we have group retained earnings of 654. Okay, so we can put that answer 654 into our answer. In fact, what we could do, perhaps to make this a bit clearer now, let's just put the numbers into our computer. There we go. Okay, so let's just add up some numbers now. So if we add up the three numbers for our property, plant and equipment, okay, so that gives us a total of 4456. And therefore we got a subtotal. So notice that this would actually be added up for you in the exam software, but I'm not using the software now, so I'm going to have to do that manually. Okay, we can add up our inventory numbers. So we've got the parent's inventory, the subsidiary's inventory, less the unrealized profit. So that gives us a total of 594. We've got the two numbers for receivables, which is 415. Got the two numbers for the cash. That gives us 183. So we've got a subtotal here of 1192. And when we add these two numbers together, it gives us our total assets of 5908. Okay, hopefully our equity and liabilities will be the same. Right, so as we progress down now, so we've got our share capital number already, we've got our retained earnings. Oh, we need to work out our non-controlling interest. We haven't done that yet. But I'm thinking about, what if I'm running out of time in the exam? Let's get some easy marks first. So let's add together our bank loans. So the total for bank loans is 460. So that's an easier thing to do than work out our non-controlling interest, isn't it? So let's get that first and earn those marks. So for trade payables, we have 362. And for the tax payable, we've got 52. Okay, so yeah, we can work out some of these subtotals to save our time. Although these would be worked out automatically for us in the software. So we just need to deal with non-controlling interest now. And that's our final calculation. there are two ways you can do this. And in our video now, we're going to show you the two ways to help you. It's up to you which way you want to do it. Okay, so the first method is for our non-controlling interest. So what we can do, we can think about, well, what was our non-controlling interest on acquisition? Well, we had 360, didn't we? That was the number that we had here. So that was the non-controlling interest when we bought the company. And then what we want to do is include their share of the post-acquisition profits. Yeah, so we got the non-controlling interest share of the profits. So remember, their profits were 50,000. We took 60% of that, and they are entitled to 40% of it. So they can have 20. Yeah, their 40% of the 50,000 is 20. So that gives a total non-controlling interest at the reporting date of 380. Okay, so that's method one. The second method, well, how did we work out the non-controlling interest in the first place? Remember what we did? We said it was their share of the net assets. So we can just re-perform that calculation, but using the year-end numbers. So yeah, what are the net assets? Remember, net assets represented by equity. So we've got the share capital, we've got the retained earnings, and we've got the fair value adjustment. So share capital is 600. Retained earnings at the end of the year is 150, and the fair value adjustment is 200. So that gives us a total there of 950. And if we multiply by their 40% share, that gives us 380. So yeah, we've got the same number, so it doesn't really matter which method you want to use. Both of them will work. So we can put that 380 into the non-controlling interest. And then when we get our subtotals, we can see that our statement of financial position balances. So our total of our assets matches the total of our equity and liabilities. So in this case, I've not used any of the workings because you can see that the space for workings perhaps isn't really big enough. But if you wanted to, you could now try and complete some of the numbers, because if you've made any mistakes, then potentially you can get some credit for any workings that you put into your goodwill calculations. So if we look on the right hand side for our property, plant and equipment, so we had the figures for the parent and the subsidiary, which was the 4256, but we added on the consolidation adjustment of 200, didn't we? For the inventories, so we had the 598 for the parent and subsidiary, and then we deducted 4, didn't we, for the unrealized profit. Yeah, for goodwill, we have our consideration. So we paid 800, didn't we? We've got our non-controlling interest of 360, and then we've got the fair value of the net assets, which was 900. So that gives us our 260 goodwill. And for the retained earnings, we've got the parent company of 628. We've got the subsidiary, and their share is 30. And then we've got the unrealized profit, haven't we? The adjustment of 4. So if you want to include those numbers in the workings, just in case, then that would be a good idea. But if you're running out of time, that's not necessarily going to be essential, as long as you've actually done the full workings and you've put the numbers into your answer.